Welcome to Money Matters. I'm Emily Johnson, Certified Financial Planner and Managing Director of Polaris Capital Advisors. Today we're going to focus our show on education, education funding, and education-related debt. I thought that it was a timely topic since we're getting into the graduation period. But before we get to that, I really want to talk about what's going on market-wise this week. And I'd be remiss if I didn't talk about, for just a brief second again, the Facebook IPO. It's potentially the largest internet IPO ever, and it's pricing tonight, so tomorrow's going to be a pretty exciting day on the NASDAQ as we watch that Facebook IPO come to the markets. And unfortunately, Facebook is coming into a pretty rocky market. We've had a rocky couple of weeks. 10 of the last 11 days have been negative in the Dow. A lot of that negativity and a lot of that decline has been spurred, of course, by continued issues in Greece and the rest of Europe. Greece has no government. We're expecting elections in Greece on June 17th. We're watching a lot of funds roll out of Greece, roll out of Greek banks, out of Spanish banks, out of Portuguese banks. And the reason that's happening is because there's a concern that those countries, as well as a few others, may no longer be part of the Eurozone and the Euro currency within the next several months. So we're seeing a lot of funds flow out. That's been negative for the markets. In addition to that, of course, we did have a pretty disturbing loss at JP Morgan that jolted the financial stocks and the equity markets in general and has created some concern about the regulation. Congress, of course, has a hyper-focus right now on regulating the banks and what that's doing to the banks. That's back in focus again as well. We continue to see a decline in gold, not to focus on the negative here, but we do continue to see a decline in gold. The reason for that, of course, is the expectation of continued slow growth. And really what we focus on when we're looking at this slow growth, there's a lot of factors, there's a lot of metrics, economic metrics, but really what we're focusing on right now is the unemployment number. And while the unemployment percentage has been improving, one thing that really has not been focused on too much in the media, but definitely that the markets are looking at, is the decline in the labor force. And they're looking at that for a few reasons. And while we have had a decline in the unemployment rate, we've also had a decline in the labor force. That means that there are fewer people looking for jobs. And what's notable, this is a chart of the past 50 years, what's notable is this portion of the chart right here, just in the last 3 years. In fact, in the last quarter, we had a 342,000 decline in the number of people looking for jobs. That's disturbing for several reasons. One, of course, is because it highlights the uncertainty in the markets, highlights the uncertainty that managers have in their inability to hire right now. It also indicates that there are probably a lot of people that are now applying for disability, specifically Social Security disability, because if you don't have a job and you need income, one of the places that people are that are able to find that is in Social Security. So as this number continues to go down, the labor force participation rate continues to go down, the number of people that are on Social Security disability continues to go up. It's a perfect correlation, or a perfect negative correlation between the two. That's disturbing as well because that also, in addition to reducing productivity in the marketplace, it also increases the U.S. debt, which again, of course, increases uncertainty as to what our Congress is going to be doing about our fiscal problems. So it's sort of a vicious cycle that we're in right now, and something that is going to be a problem probably for the next few months, and certainly in an election year it's going to be highlighted. So that's pretty much what's moving the markets this week. We'll be right back in a second. This hopefully dovetails perfectly into our discussion about education and education-related funding and education-related debt. We'll be right back in a second. This is Money Matters. Look forward to seeing you. Welcome back to Money Matters. I'd like to focus the remainder of the show today on investing in education and specifically investing in college. As graduation approaches, college is front and center in the minds of many families, but it's also front and center for the news media and for Congress these days. And the reason for that is because student loan debt is now a significant contributor to our total national debt. In fact, it actually exceeds the debt of credit cards and other consumer debt and is presently at about $1 trillion, that's trillion with a T, of student debt. In fact, according to a study by the New York Times recently that was published last weekend, 94% of students earning a bachelor's degree took out loans for some portion of their tuition. 94%. That's actually up from 45% in 1993. That means that number has more than doubled in the last 20 years. And the student loan debt, as I said, it now eclipses credit card debt, hasn't yet topped mortgage debt, but it's becoming an increasingly large problem as interest rates are expected to increase and as college costs continue to go up. So why is this happening? Well, one thing I'd like to focus on is the fact that tuition has increased 184% in the past 20 years. So as we look back at that previous statistic that we had of 94% of students taking out loans, tuition has actually almost doubled in the past 20 years. So those loans are becoming larger and larger. In fact, here's a chart right here of the college education inflation rate. You can see the massive increase in tuition expense compared to what just the basic inflation rate is. It's almost 4 to 5 times what typical inflation is. In fact, education inflation exceeds medical inflation, which is one thing that we focus on probably more than college costs these days, is medical inflation. It also exceeds home price growth. Here's a similar chart that's showing growth in tuition costs. Here's inflation, and this is growth in home prices, and of course decline in home prices here. But you can see that it has far exceeded the increase in the cost of home ownership and also medical expenses as well. So that's one reason. Another thing that's come to bear is that as the economy has become more challenged, state aid to colleges has actually increased by about 24% in the past 10 years. So we're seeing costs increase, and we're seeing less of those costs being taken on by the states. And most states actually do fund a lot of their college system. And of course, each state is going to be slightly different. California, for example, is going to be in slightly worse shape than, say, New York State, which is still able to contribute a significant amount to their state colleges. But these are, dueling factors that are definitely creating a problem in the student loan market. And this, of course, is coming to bear while competition in the workforce for jobs is at its peak. As we talked about in the first part of the show, we have historically very high employment. There are a lot of workers that are over the age of 62 that are deciding to remain in the labor force because they either can't or don't want to retire, and there are very few jobs for new college graduates. So as they graduate from college with much higher debt than they've had in the past, and as we said, tuition's grown about 184% in the last 20 years, the wages for college grads has actually only grown 9% over that same period, which is leaving students very saddled with an enormous amount of debt. And here's just a quick chart. We saw the tuition chart here 1 second ago. I'll flip back to it. Here's the increase in tuition over the past 20 or so years. And here is a chart of college earnings for approximately the last 15 years or so. So you can see that college earnings, first-year college earnings for college grads, was at its peak back in the early 2000s, and it's continued to decline. This is female college grads. This is male college grads. It's continued to decline. So as students are taking on a larger and larger amount of debt, the states are unable to assist. There's less financial aid, and interest rates have increased. We're seeing that they're able to recoup less and less when they graduate from college. So even though student loan debt is considered to be good debt by the credit rating agencies, there's still a huge weight on college grads at the moment. And unfortunately, well, fortunately or unfortunately, however you look at it, that weight is something that cannot be unloaded in bankruptcy. Student loan debt cannot be dismissed in bankruptcy. So this is a problem that Congress is facing right now, and certainly the Obama administration is trying to address it as well. But it's a very tricky problem because as you try to motivate education, you don't necessarily want to incentivize students to spend frivolously and not look at the cost of college and the cost of their university relative to what they could be making when they graduate. You also don't want to incentivize universities to continue to increase tuition because they can if the government is going to incentivize that. So it's a very tricky problem that the government's facing right now. I'm sure that you'll see a lot more proposals on the table over the coming months since we're in an election year at the moment. But it's definitely something that's contributing to our national debt. It's contributing, I think, to a lot of uncertainty in the marketplace, and something that we'll see more about. So we'll be back here in just a second to address what you should do if you're a family planning for a child to go to college, and ways that you can manage this process. Please join us. We'll be right back in just a second. This is Money Matters. Welcome back to Money Matters. So we're talking about education and specifically college, and I'd like to focus right now on college as an investment. If you're a family with a child that's on the verge of going to college in the near future, and you're probably already thinking about it, I have a 5-year-old and I'm already thinking about what the costs of college are going to be for her, you might want to think about college as an investment in the same way that you think about stocks and bonds as an investment. Think about the long-term returns for these college degrees. However, it's kind of difficult because unlike other investments where you can directly diversify your risk, with the investment in college, you're really just betting on one thing, and that investment is in, of course, the student himself. So one interesting study that was done by the College Board, which is, of course, a not-for-profit organization, estimated that a student who attends a 4-year college and borrows his way through those 4 years will likely earn enough to recoup the cost of his degree by age 33. And while that might sound like a lot, you actually are looking at about a 5 to 6% annual return. And that's even taking into consideration the large increases in tuition that we just looked at. Of course, we're talking about public institutions versus private, but they're still expensive. But regardless, if that's the case, you're looking at about a 5 to 6% annual return on your investment if you borrowed your way through 4 years of a bachelor's degree. That's really not too shabby when you consider that stocks historically have returned about 7% or so after inflation. Of course, this also doesn't take into consideration the it does take into consideration the financial benefit, but it doesn't take into consideration the intangibles of the college experience, higher job satisfaction, etc., and all of the things that come along with a higher education. And certainly, of course, there are a lot of data firms that have attempted to quantify the link between colleges and majors once a student is out of college. But there's really nothing at this point that's very conclusive. The results really vary widely. But there are a few results that the studies have in common that are pretty interesting. And again, we're thinking now about education and specifically college as an investment. So as an investment, the worst returns in education tend to come from schools whose programs focus on nursing, criminal justice, sociology, and education. Those schools tend to be more expensive relative to the return that those students get when they graduate, which is somewhat surprising. The best returns, and this is not too surprising, actually come from schools with strong engineering, computer science, economics, and natural science programs. So that's where you're probably going to get the biggest bang for your buck, so to speak, in your college planning. There's also another similarity. There's pretty poor negative returns that come from smaller private institutions that don't have significant alumni networks, that also don't have large endowments, and that also don't have the cachet that are going to hopefully get students jobs once they graduate. The large endowments, of course, help to offset some of the cost of those schools. Private colleges with significant endowments, however, and larger private colleges, which of course you can think Ivy League, it's interesting, of course, because they're able to offer their students greater financial aid, and therefore the students tend to graduate with less debt and receive a greater return on their investment. Of course, there's also more alumni network and cachet that come with some of those universities. So, it's tough to assess necessarily this return. It's also tough to compare how one degree from one school compares to the same degree from another school. You'd really have to go back and look at some of those other considerations, such as your alumni network, geographic location where the student would like to work. For example, if you want to be a lawyer in the state of South Carolina, you might want to go to USC, etc. You also might want to look at the intangibles such as specific professors or specific colleges within a university that might carry weight within a professional community. So those are some of the factors that, as we're looking at the investment in college, that you might want to consider as a family. So if you are a family with a child that's on the cusp of entering into college, what should you do at this point? Of course, if you have a senior that's about to be a freshman in college next year, that's pretty exciting. If you have a little bit more time to spend to compare college costs, that's probably the thing to do right now, is to look at the net costs of what the college is going to be after projected aid. And there are a lot of places that you can do this. One of my favorites is actually a place that the government sponsors, and it's the College Navigator tool. And hopefully we'll have that ticker up here. I'm sorry, not ticker, the web address. But what that site shows you, and this is, actually I'll skip to this in a second, what that site actually shows you is what the total projected costs are for college, as well as what the financial aid is that you can expect to receive, which gives you your net cost. So for example, I pulled up my school. I went to the University of Texas, and right now, if I were in school at the University of Texas and I was out of state, I'd be looking at a total cost of about $47,000. If I'm in state, I'm looking for a total cost of about $14,000. So obviously something that you look at in-state versus out-of-state, and this would probably be very similar to the University of South Carolina. But I'd be looking at a total cost before financial aid of approximately $47,000 out of state. On that same site, that same government navigation site, you can also look at the type of financial aid that's available. And here's the title right there if you're looking on their drop-down chart. So here you can see that approximately 68% of the students at the University of Texas take out financial aid. Here's a breakdown of the type of financial aid they receive: grants, scholarships, student loans, approximately 47% receive student loans. Here's private student loans, et cetera. So it's very interesting to look and see what types of grants, aids, scholarships, et cetera, are available at each university. And this site actually picks up pretty much every university. So now if I want to look at what my net cost is, if I were to go back to the University of Texas this year and I wanted to look at what my net cost is, I could see what my total cost would be, less my expected financial aid, and for a period of 4 years, if I were to go back today and be out of state at the University of Texas, I'd be looking at a net cost of approximately $147,000, $150,000, and that's probably before I flew back and forth to go see my parents and went on spring break. So obviously the net cost of education is increasing tremendously. Were I in state, that net cost would be somewhere more in the neighborhood of about $44,000. So I think that this is a great tool to look at, because you don't just want to look at what is the cost of room and board, what's the cost of tuition and fees. You want to see what's the likely financial aid that I can receive, what's the net cost going to be, and can we afford this? The next thing that's worth looking at, if you are a family whose child is about to go to college, is what are the salaries upon graduation? What degree programs might the student want to consider? Are they going to need to go to graduate school afterwards, et cetera? You know, if you were going to be spending, for example, $147,000 as a net cost on a 4-year degree program, and you want to graduate, to become a teacher, are you going to be able to recoup, those expenses at a reasonable in a reasonable time frame to make it worth your while? And one resource that you can look at for this is a site called Simply Hired, and hopefully again we'll have that website up here. And there are a lot of sites like this. This is just one example, and what you can do here is you enter in keywords, and then you also enter in your city, state, or your zip, and it will come up with average salaries for different for example, if you wanted to enter in engineer, right here we're looking at teachers, but if you wanted to enter in engineer, physician, whatever it might be, and then enter in the zip, it will give you average salaries in your geographic location, which just gives you an idea. If this is the cost that I take on, am I going to be able to one, repay any loans that I might take, and two, how long is it going to take me to repay those loans, and is that going to be worth my while? So, and also, it shouldn't necessarily change the job that you're looking for. It might be, well, if I want to become a teacher, perhaps I should look at a different school for the first 2 years and then transfer to a separate school. I'm not necessarily pointing this out as a deterrent from certain fields. It's definitely more of a, if this is what I'm going to be looking at in the future, how do I manage that debt today, and how do I make sure that when I graduate, it's not so much of a burden that I can't handle it and then my family can't handle it? Because certainly this is, becomes a family deal for sure. And on that note, actually, I'd like to talk about the different types of and sources of aid that you can actually look at, and I'd strongly suggest that you start looking at these sources early. You start looking at these sources early. There's 3 main sources of aid. One is scholarships and grants. Those, of course, are merit-based and need-based. Then you also have student loans. Those are loans that the student's going to take on. Those usually come in 2 main flavors. One is subsidized. The other is unsubsidized, with subsidized, of course, being the more favorable of those 2 types of loans. And then the last one is parent loans. These are the ones that the parents are on the hook for, and they're called plus loans. Those are the kinds of loans that start accruing interest from day one, versus the different types of student loans that are available. So those are 3 types of aid that you might look at if you have a student that's about to apply for college or is applying for college, somewhere in that sort of freshman, sophomore, junior year. The next thing that you might want to look at, of course, is if you have a young child like I do, is starting to plan for those college costs now and not necessarily getting scared by it. One great source is the South Carolina Future Scholars Program. There are lots of 529 programs. This is just one example. This is the one that's sponsored by the state of South Carolina. This is their website. If you go on it, you can pop in this section right here where it says plan, and you can figure out how much is this college going to cost. Of course, it's going to scare you, I promise, how much college is going to cost when your child goes to school. But then it also gives you an idea of what can you save now to hopefully get closer to achieving that goal, and then make up that gap with any potential scholarships, grants, and financial aid in the future. But those are just some ways that you can look at managing these costs. So hopefully that takes some of the fear out of that, but it's certainly an interesting problem. This is something that's going to be on the forefront for several months. It's going to be a hotly debated topic from the student debt perspective, but for families whose students are about to go to college, it's an exciting time, and there's a lot of options that are available to you. So hopefully this has been helpful. This is Money Matters for today. This is our topic on education. We certainly welcome your ideas. Please send us notes on Facebook. Email me with any ideas. We certainly welcome them, and we look forward to seeing you next week. I'm Emily Johnson, and this has been Money Matters.